Hi there, Chuck Gibson from Financial Perspectives in Pleasanton, California. I'm going to make a small change going forward. I realized in my attempts to keep these videos to under 10 minutes, I was not able to recap the entire market. So I had to make a decision to either extend the time and do a more complete job, or keep the time reasonable and just cover those things that I feel are most important. Well, I'm happy to say for myself, and especially my listeners, that brevity won the tug of war. And as such, I am changing the name of this monthly ditty to Charts on the Move. Please, let's have a moment of silence for the monthly market recap. Okay, thanks. I got a lot to cover, so let's get right to it. My first chart here is a weekly look at the US S&P 500 index. As you can see, we are basically in the same place we were 1 year ago. The 200-day moving average is flat, indicating indecision and no trend. As investors, we want to avoid those things that are not trending and moving sideways. Essentially, we've been in a trading range that I have bracketed by the two red horizontal lines for the past 20 months, bouncing between 1880 and 2126. For now, and until the index wants to break either higher or lower, we're in no man's land and it's testing our patience. While it's still early, I have drawn in a blue a potential rounded top reversal pattern that is currently developing, and it has my attention. On the plus side, the September-October correction, it unwound the negative divergence on the momentum indicator, which would allow the index some room to run if it eventually breaks higher. We still also have the potential for a seasonality tailwind, but that has yet to hit. The bottom line here is that there are multiple messages and they're all mixed, and this has brought out the yellow caution flag. If we expect the markets to rise going forward, we want and need to see the generals leading its advance. Let's take a look at some of the past leaders and see what their charts look like. First off, let's take a look at the technology via the Qs, QQQ. This has been one of the major standouts during this 6-year bull run. From the October bottom, notice how it made a higher low and then quickly moved on to all-time new highs. This chart is still very bullishly aligned, as price is both above its long-term uptrend line and the red 200-day moving average, which is also pointing higher. We need to not only see this index trade and hold above the 116 level, but we also want to see its breadth expanding. The next chart is that of the small cap stocks, IWM. Like technology, if the markets are going to move higher, the small caps should be one of those sectors leading the charge. This index moved higher from a lower low in October rather than a higher low like the Qs. As such, the move higher was less robust, and we have yet to move on to all-time highs. And right now, we're sitting just under major resistance. It is constructive in that we are making higher highs and higher lows from October, but on the downside, price is below the blue 200-day moving average, which is flat. Unfortunately, this is indicative of no trend. It implies a trading range and sets up the potential for whipsaws. As you know, I prefer to avoid investments where the 200-day moving average is either flat or negative. Seasonality is strong for small caps during the end of December and all of January, so what we can hope for is a robust push higher, bringing the 200-day moving average along with it and eventually moving on to new highs. It would be unfair when talking about market strength to not mention the biotech stocks. They have been the market racehorse, outpacing all sectors from the 2011 bottom. This is a weekly chart, and it's presenting a potentially ugly story. Price fell below the blue long-term uptrend support line and has made a series of lower highs and lower lows. Price is now below the 200-day moving average, and it's flat. Additionally, the current consolidation area that I have drawn in red has taken the shape of a bear flag. We need the biotechs to get going right now and to move higher. Otherwise, I fear if we continue to see weakness and price falls below the lower flag support line, it could lead the market lower, reaching its target some 20% down from here. It seems I can't go a month without mentioning the dollar, as it continues to be the 6,000-pound gorilla in the room. It was my view last month we had broken out of a 9-month symmetrical triangle, which pointed to much higher prices. The first point of resistance would be the prior high at 100. If it could find its way above that, the potential for a much, much higher price would be likely. Wednesday, though, right on cue, Janet Yellen and Mario Draghi had parallel news conferences, which had a less accommodative message than investors were expecting. Immediately, the market crushed the dollar, stocks, and bonds together. The dollar reversed right off the prior high resistance at 100 and moved impulsively and strongly lower. So if the market changes, so must we. The dollar is now likely trapped in a much bigger trading range between 93 and 100, waiting further signals from those master monetary miscreants rather than a moonshot higher as I expected. If this reversal holds, and it's not a 1 or 2 day event, I would expect to see a potential bounce for commodities and some foreign-based investments. Since it's been a while since we last checked in with them, and considering the potential for a dollar reversal, it's probably worth looking at a couple of foreign equity charts. I have not given these markets their fair shake in my past recaps, not for any other reason, for the fact that they've been bringing up the rear in underperforming U.S. equivalent investments for the past 3 years or more. My first chart is that of our Asian stock market proxy, AAXJ. It's been in a nice uptrend from the 2011 bottom until July of this year, where it broke its uptrend line and eventually the red horizontal support line. Like all foreign investments, it's been struggling against the backdrop of a strong dollar move, forming a bear flag pattern in the interim. If that pattern completes, it's indicating another 25% downside. Notice how over time, price has fallen below the red 200-day moving average, which is also now pointing down. In the bottom pane is the ratio of relative performance of the S&P 500 versus AAXJ. If the line is pointing higher, that indicates the S&P is outperforming. If it's pointing down, AAXJ. As you can see, the S&P has been massively outperforming over the last 5 years by more than 80%. Hopefully it's clear from this as to why we've had little to no money allocated to Asian stocks. My next chart is that of the emerging markets. It looks very similar to the Asian chart I just showed, but with a major difference. Instead of being in an uptrend from the 2011 bottom, it has been consolidating sideways for the entire 5-year period. Like Asia, it too has formed a bear flag, warning of a potentially lower prices ahead. Note in the bottom pane of relative performance, it, like Asia, has lagged the U.S. markets, but only worse. The emerging markets are nearing 120% underperformance over the last 5 years. To close out this month's video, I wanted to look at something I've never talked about yet, which is high-yield debt, otherwise known as junk bonds. Junk bonds provide a much higher income stream, but that doesn't come without greater risk. You see, junk bonds tend to move like stocks instead of bonds, and unfortunately, many who invest in them find this out too late. For example, in 2008, this ETF lost 40% of its value, whereas government treasuries moved higher. Armed with the knowledge that many stock market corrections were caused, at least in some part, by disruptions in the bond market, this chart has my full attention. As you can see, like stocks, we've been consolidating sideways for more than 2 years. We have made a series of lower highs and lower lows and are sitting right at a line of critical support. In addition, price is below the 200-day moving average, which is also pointing down. My concern is if price can't hold here and it turns lower, depending upon how bad it gets, this could be the catalyst for something more than just a stock market correction. A break below the 2013 $33 low would be damaging. For now, though, all we can do is wait and watch. Well, that's it. As always, I appreciate your time and attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with November's Charts on the Move.